We are back in the black hole of real estate, and a lot of you have asked me what's going on with Fed rates as it pertains to mortgage interest rates. And there's a thing that I want to call the zigzag, and we're going to talk about that today. This is your host, Ron Wysakarski, for the black hole of real estate. Feds have dropped a quarter point last week, right after the election, on top of a half-point reduction not that long ago in the last month or so. So it's 3/4 of a point. The federal funds rate has gone down. That's the rate that the banks can borrow money from the Federal Reserve. So 3/4 of a point has gone down. But when you look at mortgage interest rates, they've gone up almost 1% during that time, which for a lot of people doesn't make sense. So I'm going to do my best to break this down in a way that is understandable of what's going on and why this zigzag is occurring right now, because I think the foregone conclusion as the Fed rate went down, most people felt that mortgage interest rates would also go down by a similar amount. And it's a big inflection point when the Fed is down 3/4 of a point, but interest rates went up almost a full percent. I mean, it's almost a 1.5%, 2% swing. And that was unexpected for many people that were getting ready to buy a house. And so, what do we do next? Well, as a consumer, I want to remind you that the rate today is not necessarily the rate that you're going to get when you actually go under contract. And I think this is an important piece to really, really think about. So if you start your home search today, but it takes you a month or two to find the right house, or maybe you're pre-qualified at today's rate, which is a little higher, you'll have perhaps the upper limit of what your monthly payment might be at a certain price point. And if it's going to take a week, a month, or 2 months, then rates could absolutely go down. There's a Fed meeting that will take place in December, and then more after the first of the year. So there might be time for the rate to come down by the time that you choose the right house and go under contract. So that's something I want to give you right now, because if you're losing a little bit of hope or faith in what's going on with interest rates, my suspicion is this is temporary. Now, how do we get to a point where the Fed goes down and the rates go up? It was a foregone conclusion, not this one, but back in October when the Fed was probably predicted to go down 1/4%, the banks and lenders were pricing in that quarter point. It actually went to a 1/2 point. It's not lost on me that so much of that was priced into rates. There was probably some concern that if they only went down 1/4 of a point, that the rates would whipsaw north, higher. So they went to the 1/2, and it still went up. And then they go down another 1/4, and rates, trickled up. Now, here's some things that I'm noticing in the market that might have contributed towards that. The first thing is, the elections, they just ended, but there's been a lot of uncertainty in the market. The employment numbers, for those that choose to believe them, and I'm not saying you should believe them or not believe them, but there's some skepticism in the employment numbers. And is the unemployment rate that low, or are they counting and not counting certain things to make that number appear super low? We'll see. They could be exactly where they are, or they could be a little bit off. But because there's skepticism and uncertainty, especially what we've seen for the past few months, I think it's going to take a little time to sort itself out. So I think that's a really, really big piece right now. There's some skepticism on things like unemployment numbers. The same can go for the inflation numbers. Has the Fed really trimmed inflation to the extent that they can take off 3/4 of a point? I mean, their actions suggest yes. And, we really hope that, inflation, if that's tapering off, that might be a very, very good thing right now for home buyers and just, cost of food and goods. And so we'll see. Now, things like GDP and all that other stuff that goes along with it, the consumer price indexes, are they trending in the right direction? And then we just get back to the mortgage interest rates. And by now, you've got a headache. You've absolutely got a headache, which is why I'm going to bring you back to, if you're just starting to look, go ahead and look. find the right house, or at least learn the neighborhoods, learn the types of things that you're looking for in a home. We start out with 3 bedrooms and 2 baths, and we realize that 2 bedrooms might be okay. Or we really need 4 bedrooms or even 5. Or maybe those small kitchens are perfect because you eat out a lot, or you're on the go, or you're a business professional that rarely eats at home or rarely cooks. Or maybe you've got a growing family and you love to cook and you realize there's not enough counter space, or there's not enough kitchen cabinets to fit all the things that you want to work with. I believe that the more homes you look at, they start to teach you what you're looking for, and it really helps you dial in the right house. And with that, the right house at the right price. And with inventory such that it is right now, I believe it's going to take longer to go through the investigation process of the right home first, then the right price. You see, it's backwards. If you start with the right price, you're probably never going to find the right house. You know what the upper limit of budget is, but what you're not factoring in is the seller on the other side. Is there a home, if your budget's $300, is there a home priced at $350 that's priced overly optimistic? Or maybe the seller might have a situation where they need to move that property to $299 rather quickly. Would you have liked to have seen it when it was overpriced at $350? So when you notice the price reduction, it slides into a range. Maybe it only gets down to $310. But would they take a number that fits your $300,000 budget? See, I think it might. I would run what I call parallel searches. And what that means is search everything under $300 if that's your price, and that's a fictitious price. But let's say everything below $300, and then see if there's anything in your criteria. Are the repairs or changes or renovations needed acceptable? If the things you do after closing, great. But then I'd also run a search of everything you want on the wish list, and maybe cap it at $350 or even $400. And this will give you a really good idea of what you got to have, what's a nicety, what's a necessity. And within that, you're going to identify homes at certain price points that might be the right ones for you. And should we get a reduction in price through an overly optimistic seller with regards to price, and a change in the interest rates, that home in the $350 range might float down to the right price and a far better payment. Now, I'm not suggesting that the one at $400 is going to float down all the way to that price point, but we can ask the seller to do something called a 2-1 buy down, where the seller helps pay for some of the interest in the first couple of years. And if the interest rate was 7, the 2 subtracted from 7 is 5, so you get 5% in the first year and 6% in the second year. And by that time, you would likely have a chance to refinance into a rate in that range, so you'd have an affordable payment ongoing. Now, there's a lot of strategies that we can use to counteract this zigzag going on. Now, I know I said I was going to talk about the mortgage zigzag compared to the Fed rate. That gave you what amounts to probably a migraine, unless you really just eat up the financial stuff and really enjoy that kind of talk. But here's what I would tell you. Somewhere, there's someone, maybe smarter than me, that has a better sense of where the market is heading with the interest rates and the Fed rates and inflation and all those other things that I mentioned. But my suspicion is they might just be a better guesser, because the crystal ball from here that I'm staring at really doesn't know. I mean, can we truly see around corners? Can we capably predict where the market is going? Because I think most people would have said the Fed goes down, the interest rates went down. And we've said here that may not be the case. If the bank's already priced it in, it probably wasn't going to happen. It's also end of the year for the banks, and they could be margin cutting to make sure their P&Ls look really, really good for the end of the year. Maybe they're short on staff. They're letting some people go. They can't handle the amount or the volume of applications coming in. That could be a reason. Rates can stay higher if they can't process the work. It could be that maybe some people are anxious for, Trump got elected. We could say the name, right? He's going to be the president. What's going to happen over the next couple of months? There's a lot going on. The usual holidays and things going on. It could just be people are like, okay, let's exhale. We got a few things out of the way. Some decisions were made in these elections. We got the Fed to reduce. We didn't see the interest rate reduction yet. But I do think it's coming. I would say monitor the market. But start studying the properties now. That there's no downside to looking at properties. If you don't purchase, then nothing. I mean, so you lost an afternoon or two. But you got to educate yourself on the type of home that you want, the price points that are available that you can study and watch and monitor. And as the rates come down and maybe the prices come down on a house that you're looking at that's been lingering on the market, I think that might be a really good combo. The other side is because you will have this education base of properties in the market right now, if a property comes on the market, and let's use your $300,000 budget, I don't know, 310, 320, and it's a hot property, it would give you the confidence to go out there and make an offer if that's what you chose to do within the first few days that it's on the market. See, the hot properties that fit that criteria, they're always going to sell fast. And armed with the knowledge of seeing some properties and understanding the dynamics of pricing and condition and repairs afterwards, I think it's going to be easier to make maybe a quick decision, if needed, on a property that comes on and meets all of your criteria. So yeah, there's a zigzag going on, and it might complicate things, but my message today was, let's not sweat the interest rate right now. We know that companies are offering waiving all the lender fees on refinances, and we do expect rates to go down sometime in the next year or two to a really, really good rate. So with that in mind, let's find the right house. Let's understand how the interest rates are being affected right now by market conditions, but mostly, let's find you the right house. And I think that's the most important thing. So, if you're working with an agent, fantastic. They'll guide you through the process of selecting the right home. If you're doing it on your own, hey, that's okay too. A lot of people can do that. I'm just excited that there is some energy in the market, and I do see an increase in listings probably coming on the market because the logjam, I think, is starting to break as far as the inventory gap that we have. I think good things are ahead for buyers and for sellers, and I hope that this message helps you understand a little bit about the zigzag between the Fed and mortgage interest rates, but also how we can combat it. This is Ron Weiss-Zakarski for the Black Hole of Real Estate.